Welcome to the December 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by MAV, Federal Reserve Policy Decision and Economic Outlook. MAV provided a detailed analysis of the Federal Reserve's December 2025 meeting, which saw it deliver the anticipated 25 basis point cut, bringing the federal funds rate to a range of 3.5% to 3.75%. The decision notably featured 3 dissenters among the 12 voting officials, with several others preferring to wait for additional information before proceeding. Governor Moran maintained his preference for a 50 basis point reduction. The FOMC reintroduced language regarding the extent and timing of additional adjustments to the federal funds rate, mirroring rhetoric from 12 months prior that effectively signaled a pause in monetary policy adjustments. MAV characterized Chair Powell's press conference as possibly his strongest performance to date, contrasting sharply with the previous December's shambolic presentation, where Powell appeared rattled by questions regarding the incoming Trump administration. Powell articulated the tension between labor market softening and persistently elevated inflation, suggesting the current rate range represents approximately the upper bound of neutral monetary policy. MAV initially assessed neutral rates at around 4%, but subsequently revised his view downward to the current 3.5% to 3.75% range, potentially marginally higher, based on the pause in population growth and potential for more sustained productivity improvements. The Federal Reserve updated its GDP forecast for 2026 to 2.3%. Representing an upward revision that MAV attributed partially to productivity gains and partially to the government shutdown reducing 2025 growth by approximately 20 basis points, from a potential 1.9% to 1.7%. Powell expressed confidence that productivity improvements, whilst currently influenced minimally by artificial intelligence, would continue supporting higher growth trajectories with reduced inflationary pressures. Equity markets responded particularly positively to productivity commentary, with key indices increasing during the press conference. The unemployment forecast remains relatively stable at approximately 4.3%, with inflation projected to return to the 2% target, though MAV again expressed skepticism regarding this inflation trajectory. Labor market dynamics and data quality concerns. Powell explicitly stated the FOMC's skepticism regarding establishment payroll figures, anticipating forthcoming revisions, demonstrating average monthly employment declines of approximately 20,000 positions. MAV noted Powell appeared to possess advance information from the Bureau of Labor Statistics given the confidence with which this assertion was made. This revelation potentially contradicts MAV's previous assessment that labor market softening resulted from equally declining supply and demand dynamics, suggesting demand deterioration may exceed supply changes. The break-even payroll figure, accounting for reduced population growth from zero net migration, was estimated between 20,000 and 50,000 monthly additions. Should the negative 20,000 figure prove accurate, demand weakness would represent a more significant factor than previously assessed, potentially moderating the anticipated first-quarter inflation outbreak that MAV has forecast. Powell indicated that employment and inflation data scheduled for release in subsequent weeks would likely prove highly distorted due to technical collection issues and incomplete gathering periods. Consequently, the FOMC would disregard these releases regardless of whether results appeared exceptionally positive or negative, instead focusing on January data covering December activity, which would be comprehensively collected and normalized. The October JOLTS report presented mixed signals, demonstrating increased layoffs alongside the largest increase in job openings observed in approximately 6 months, substantially exceeding expectations. This unusual combination of rising layoffs, concurrent with expanding job openings, suggested complex labor market dynamics not yet fully understood. MAV acknowledged the need to potentially rely more heavily on private sector employment data, which requires different analytical approaches compared to traditional official statistics. The overall labor market assessment remained characterized as softened but not collapsed, driven by both supply and demand factors, though the precise balance between these forces required further clarification. Quantitative policy adjustments and term premium implications. The Federal Reserve announced an unexpected return to quantitative easing for short-term bills and treasuries up to approximately 2 to 3 years maturity. Despite having only recently concluded quantitative tightening at the beginning of December 2025. This decision aimed to address anticipated liquidity shortfalls arising from substantial government spending associated with the One Big Beautiful Bill Act and seasonal factors surrounding the 15th of April tax filing deadline. The resumption of asset purchases sought to prevent the effective federal funds rate from breaching its upper bound of the target range, an issue that had emerged prior to the quantitative tightening cessation as the effective rate approached the previous range ceiling. Bond markets responded favourably to this announcement, with yields declining across the curve, particularly concentrated at the front end, providing some relief for equity valuations. The term premium in US Treasury markets exceeded 70 basis points as of the presentation date, representing a significant threshold not meaningfully breached for some time. MAV projected continued upward momentum, potentially approaching 100 basis points, driven by stronger economic growth expectations. The composition analysis demonstrated the real component of the curve would likely rise given improved growth prospects. 10-year Treasury yields could feasibly return to mid-4% levels, having already approached 4.18% immediately prior to the FOMC meeting before declining slightly following the announcement. Australian 10-year government bond yields reached approximately 4.80%, creating a circa 60 basis point spread over US equivalents, substantially exceeding MAV's anticipated 40 to 50 basis point differential. This development reflected market disappointment regarding Australian inflation persistence and the elimination of previously priced rate cuts, with markets now positioning for rate increases. The substantial yield differential raised questions regarding Australian dollar strength, which remained approximately 66 cents against the US dollar, rather than the purchasing power parity implied 69 to 70 cents. Global inflation dynamics and market implications. Stephen Duchesne, SD, highlighted that inflation remained elevated globally, with most jurisdictions experiencing rates in the 3% to 4% range. The European Union demonstrated considerable variation, with Romania experiencing approximately 8% inflation, whilst France registered below 1%, illustrating the heterogeneity of inflationary pressures. Yield curves globally demonstrated significant steepening over the preceding month, with the US 10-year moving approximately 40 basis points, Australian yields increasing 40 basis points, Japanese government bonds rising 30 basis points from 1.6%, and Chinese yields also advancing. This global bond market repricing occurred despite individual central banks confronting the balance between employment objectives and inflation control, raising concerns regarding potential policy errors given limited capacity to respond to shocks in either direction. SD expressed qualified optimism regarding 2026 market performance, whilst acknowledging significant downside risks given elevated valuations. He referenced a Federal Reserve paper analysing US equity returns from the 1960s through 2020, which determined that mean real returns of approximately 7.5% consisted of GDP growth around 2.5%, with the remainder attributable to declining interest rates and tax reductions. This analysis suggested that historically, economic fundamentals justified equity appreciation, though future returns could not rely upon further interest rate declines. Strategist forecasts for the S&P 500 averaged approximately 7,350, with Oppenheimer projecting 8,100, representing substantial optimism. Morningstar analysis of 700 US listed equities indicated valuations at a small discount to fair value, which MAV found surprising given Morningstar's typically conservative methodology. However, achieving projected 18% to 20% annual returns depended critically upon the 7 largest technology companies, which represented one-third of S&P 500 market capitalization and 25% of aggregate earnings, equivalent to 1% of GDP. Kingsley Jones, KJ, noted that commodity price strength, particularly in silver approaching $60, platinum, palladium, and copper, suggested robust global activity. Unlike post-global financial crisis commodity booms driven by excess demand, current metal price appreciation appeared more consistent with monetary inflation, potentially presaging sustained asset price increases driven by liquidity conditions rather than fundamental demand-supply imbalances, reminiscent of post-quantitative easing dynamics. Interest rate projections and domestic market and economic discussion. Mav walked the committee through the latest market positioning on policy rates for the US, Australia, the UK and Japan. Mav is concerned that Japan could hike rates by more than investors are anticipating over the next 12 months, and that this would have implications for volatility, asset rotation, and liquidity more broadly. Such a scenario would place the ASX under immense pressure as it is trading at 21 times earnings, average 15.4 times, and just a 3.1% yield versus its 4.1% long-term average. There was further discussion about the exchange rate and commodity prices and implications for currency hedging. Mav provided a brief analysis of the September quarter GDP figures. These showed zero per capita growth and a rundown in inventories. However, beneath the surface, domestic final demand surged, and this was led by the private sector. Investment in imported equipment jumped as data centers received extensive fit-outs. Nominal GDP also rose, and this has implications for revenue and earnings growth for the second half of this calendar year. Mav also discussed the recent RBA decision to pause the cash rate at 3.6%, as expected. The hawkish accompanying statement and post-meeting presser expressed that additional cuts are not needed and ruled out any rate reductions in the foreseeable future, citing solid private demand. Mav commented on this hawkish shift: inflation concerns, data dependency, the labour market and total spending, private and public. Markets are now positioned for 2 rate hikes in 2026, commencing around May. Mav again expressed disagreement with the RBA's view that the labour market is tight, and he expects no change in interest rates in 2026 as inflationary pressures slowly dissipate. This discussion also analysed trimmed mean inflation in Australia for the CPI and in the US for the CPI and PCE inflation, where new charts were displayed. Domestic and US trimmed mean annual CPI inflation is currently at similar levels at around 3.25%. Yara Capital Investment Market and 2026 Outlook. United States Economic Outlook and Fiscal Position. Tim Toohey presented a cautious assessment of the United States economy, challenging the prevailing optimistic consensus. Whilst tariffs were initially labelled as part of a chicken-out trade, they remained broadly consistent with the reciprocal tariffs introduced in early April. The firm estimated tariffs would add approximately 0.9 percentage points to core inflation, with Federal Reserve Chair Powell suggesting inflation would reach 2.8%, of which roughly 0.1 to 0.2 percentage points stemmed from tariff effects. Critically, Toohey noted that tariff revenue, rather than being used to reduce the budget deficit from 7% to 3% of GDP as promised during the election campaign, would likely be directed towards tax cuts to favour certain constituencies in 2026, with Trump suggesting a one-off dividend to households. The fiscal outlook presents substantial concerns. The budget deficit is projected to experience a significant blowout in the next year and into 2027. With most savings measures only taking effect after Trump potentially leaves office. The debt trajectory is approaching a critical threshold where the budget deficit remaining at 6% of GDP would exceed the nominal growth rate of the economy, a development that historically concerns bond markets. The yield curve steepening represented an unusual phenomenon, occurring despite the Federal Reserve entering an easing cycle. This steepening reflected not an improved growth outlook or inflation risk premium, but rather a risk premium for holding long-dated debt, indicating bond market skepticism regarding fiscal sustainability. Tuhey suggested this steepening trade would likely recur in 2026, with expectations of dollar weakness returning in the latter part of the year. The underlying economic momentum appears considerably weaker than headline figures suggest. Whilst headline GDP appears satisfactory on a quarterly basis, final sales data and broader economic indicators paint a more subdued picture. The housing market is contracting at its fastest rate since the financial crisis, with many southwestern markets experiencing house price declines. Employment growth remains virtually non-existent, with layoffs beginning to emerge. Real income growth appears flat to negative when accounting for inflation at 2.8% and slowing wage rates. Investment excluding artificial intelligence and data center expenditure is negative, representing a recessionary signal. Tuhey's nowcasting model, which aggregates approximately 50 different indicators, suggests the recovery that occurred was less robust than interpreted, with the economy remaining locked in a slow growth environment, showing limited signs of improvement. Labour market dynamics and monetary policy effectiveness. The unemployment rate has reached 4.4%, placing it about 2/10 away from triggering the SARM rule, which indicates recession risk when unemployment rises more than 0.3 percentage points relative to its 12-month average. A critical leading indicator suggests further deterioration. The proportion of people not in the labour force who want employment has spiked, typically preceding increases in unemployment. This dynamic, driven partly by cost of living pressures and labour market stress, suggests the SARM rule could be triggered again in the latter part of the year. The transmission mechanism of monetary policy has fundamentally altered. The household sector now holds deposits approximately equal to household debt on a dollar-for-dollar basis, meaning a 100 basis point movement in interest rates simultaneously hurts some households whilst benefiting others to the same degree. This represents a redistribution of income between wealthy and less wealthy cohorts rather than a genuine economic stimulus. Whilst Australia has also experienced some diminution of monetary policy effectiveness, it remains closer to 2003 levels and retains greater transmission power than the United States. The wealth effect, traditionally a key channel for monetary policy impact, is also deteriorating as house prices are no longer appreciating and refinancing opportunities have diminished. This is particularly significant given that consumption has become increasingly concentrated, with the top 1% driving approximately 18% of consumption compared to 13% a decade ago, and the top 10% accounting for 49% of all consumption. Capital expenditure excluding artificial intelligence investment registers as slightly negative, representing a level consistent with flat demand across the broader economy rather than robust growth. This recessionary-type signal contrasts sharply with the narrative of strong economic fundamentals. Regarding artificial intelligence, whilst productivity growth appears solid at approximately 2.1%, this merely matches the long-term average since 1950 rather than representing a breakthrough. Tuhey expressed skepticism about near-term productivity gains from artificial intelligence, suggesting benefits would materialize over the next decade rather than the next 10 months. The circular financing amongst a select group of technology companies deploying capital expenditure indiscriminately in hopes of competitive advantage represents an environment that typically competes away returns. The concentration of global capital flows into a narrow range of names creates nervousness regarding market volatility, particularly given economic data will be inherently lumpy due to government shutdown effects and artificial intelligence expenditure distortions. Australian economic recovery and inflation dynamics. Tuhey presented a controversial view suggesting the Reserve Bank of Australia would implement 3 additional rate cuts, contrasting with consensus expectations of 2 rate rises, and MAV's view of an extended pause. This assessment rests on several factors: misinterpretation of inflation data, contained wage growth, positive productivity performance, and anticipated Federal Reserve easing. The inflation surprise in the September quarter stemmed largely from electricity subsidy base effects, adding 0.6 percentage points to the 3.8% headline figure. New South Wales and Queensland exhausted their federal subsidy allowances by July. But from 11th October, New South Wales received a double payment. This will create an opposite effect in the December quarter, producing a negative inflation surprise that should wash out recent micro-pricing. Several inflation components represent temporary effects that will dissipate. Gold and silver price increases affected accessories pricing in an unprecedented manner, requiring continued price acceleration to maintain inflation contributions. Apparel price increases appear to be import price noise with no persistence in global trade data. The tobacco component warrants removal from inflation calculations, as the inclusion of illicit tobacco trade and consumption measurements creates distorted shadow pricing. When properly measured, this should generate disinflation, potentially materializing in the final quarter of the year. Critically, when examining the composition of the inflation basket across 89 different items, no clear breakout is evident. Approximately 40% of the basket grows at less than the bottom end of the target band, with no material shift in the proportion of items growing above 3% or below 2%. The 6-month annualized inflation rate stands at 2.7% since May, with 3-month annualized at only 1.5%, contradicting claims of an inflation breakout. The Reserve Bank has revised its estimates for both potential growth and the real neutral interest rate downward. In November of the previous year, including commentary from the Deputy Governor, the real neutral rate was estimated at 1.0%. Bullock subsequently revised this to 0.5%. Combined with the 2.5% inflation target, this implies a nominal neutral rate of 3.0%, compared to current market pricing, suggesting insufficient easing. This is close to MAV's estimate of around 3.25%. Internationally, central banks have broadly aligned their policy rates with neutral rates plus inflation gaps, but Australia remains an outlier. The household cash flow position is improving materially, not primarily due to tax cuts or rate cut impacts on interest servicing, but rather from normalisation of essential spending categories. Expenditure on insurance, interest payments, rent, and utilities has been moderating sufficiently to create positive free cash flow at the household level, supporting discretionary spending recovery. Volume consumption of utilities has declined 12% over 2 years, an unprecedented peacetime contraction, indicating genuine household sensitivity to these costs and confirming subsidies did not translate into increased disposable income. This cash flow improvement underpins a building recovery with durability, though not one generating excess demand or inflationary pressures. Australian asset allocation and market positioning. The Australian economy presents several structural advantages relative to global peers. Household wealth as a proportion of GDP not only exceeds the United States, but the gap is widening, partly attributable to the superannuation system. Australia will remain a beacon of fiscal sustainability amongst G7 nations and beyond, with debt trajectories and budget deficits projected to remain materially lower than developed market peers over coming years. This fiscal position, combined with improving growth dynamics, supports a favourable investment outlook. Capital flow dynamics are shifting favourably. The portfolio equity capital flows chart show the yellow line moving towards the axis, indicating superannuation funds are reducing offshore allocations whilst foreign investors are increasing Australian exposures. Japanese investors are particularly active, with hedged yields making Australian fixed income attractive. The all-in hedged yield for Japanese investors has reached unusually attractive levels, prompting rebalancing away from United States allocations towards Australia. This dynamic supports both fixed income demand and Australian dollar appreciation, with Tuhei expecting the currency to reach the low 70-cent range in early 2026. This would further support the case for Reserve Bank easing, as the central bank places significant weight on the exchange rate as a monetary policy transmission mechanism. If the Federal Reserve implements up to 100 basis points of cuts through the year, particularly with potential personnel changes at the Federal Open Market Committee, the Reserve Bank cannot maintain current settings with the Australian dollar at 72 to 73 cents. Housing market dynamics remain supportive of growth. Housing approvals have begun responding to the rate cuts already delivered and improved affordability. The undersupply of housing represents an unprecedented magnitude, with approvals versus commencements versus work done data suggesting sustained activity increases ahead. The Reserve Bank appears to misinterpret housing inflation, attributing rises in house and land packages to demand pressures when these actually reflect removal of discounts introduced during the 2023 to 24 period when sales collapsed. This represents stock clearance rather than sustainable inflation. With rates declining another 2 to 3 times through the year, the recovery benefits from enormous shortage, improved affordability, and government policy alignment. Demographics remain strong long-term, with the capital expenditure outlook showing material upgrades in the recent expectations data. The latest estimate showed step-ups in both equipment and buildings, with increases across manufacturing and other sectors. Whilst data centres represent a component, these are largely imported with minimal ongoing employment, creating temporary rather than sustained spillover effects. Nevertheless, business balance sheets are healthy, profits solid, and the term structure favourable, creating scope for broader investment improvement beyond data centre concentration. Valuations and other thoughts. Valuation perspectives suggest caution regarding United States equities, whilst Australian cyclicals appear positioned for recovery. United States margin lending has surged dramatically, with substantial retail participation using leverage, creating a potential amplifier for any correction. Australia lacks comparable imbalances. Earnings per share momentum in the United States, when mapped to final sales, reveals significant divergence. Final sales growth suggests either substantial acceleration is forthcoming or earnings will roll over, with the latter appearing more probable given starting valuations. The quality factor experienced severe underperformance through 2025, with historical correlations breaking down. If the analysis suggesting Federal Reserve cuts amid overestimated growth proves correct, the steepening trade and associated rotations from the first half of 2025 may recur in the first half of 2026, potentially preventing quality factor recovery and creating challenging positioning for many investors. Australian earnings per share growth consensus estimates around 9% for the coming year appear reasonable, driven primarily by resources and media, with contributions from discretionary sectors. Following 3 years of negative to flat earnings growth, a cyclical recovery in private demand that has been underestimated should translate into 5 to 6% earnings growth. Industrial sectors trade at reasonably expensive valuations, with banks and miners well understood. But micro-cap and small-cap segments remain the cheapest part of the market despite strong second-half performance. These companies possess operational leverage to the domestic cycle, interest rate sensitivity, and margin expansion potential from predominantly being importers, creating a sweet spot for the expected environment of domestic cycle pickup, lower interest rates, and higher Australian dollar. Discussion. Economics. The committee engaged in extensive discussion of Tim's economic presentation, noting several areas of divergence from consensus views. Most notably, Tim's forecast of 3 rate cuts for Australia contrasted sharply with Mav's expectation of no change and market pricing of 2 rate hikes, representing an unusually wide disparity of views. The committee found particular value in Tim's Financial Conditions Index analysis, which showed conditions had tightened despite recent GDP acceleration, raising questions about the sustainability of current growth momentum. The committee examined Tim's positive outlook for Australian housing construction and population growth, which underpinned his more optimistic view on the domestic economy than some members shared. Discussion of Japan's inflation dynamics proved insightful, with the committee noting the shift from traditional energy-driven inflation to food price impacts and tourism-related pressures, which MAV identified as a potential X factor for 2025. On global debt sustainability, particularly US fiscal trajectories, the committee acknowledged Tim's concerns about bond market nervousness, evidenced by long-end selling pressure. The committee found Tim's analysis of monetary policy effectiveness particularly fascinating, especially the chart demonstrating decreasing effectiveness in the US compared to Australia's short-end-focused transmission mechanism. His relatively positive stance on Australia versus the US, despite noting Australian equities did not look cheap, presented an apparent contradiction that warranted further consideration. Portfolio construction. The committee proposed two modest adjustments to portfolio positioning while maintaining the overall 60-40 growth defensive strategic asset allocation. Members expressed general satisfaction with current allocations, particularly the overweight to growth assets at 4% above target, which they deemed appropriate given the current environment and not requiring adjustment despite early signs of US economic weakness. The first proposed change involved increasing the hedged proportion of international equity exposure. Given MAV's view of no more rate moves and Tim's highly non-consensus view for 3 RBA rate cuts, observations about Japanese fund flows into Australian fixed income, and Australia's favourable net debt to GDP position globally, the committee agreed to increase currency hedging. The discussion centred on appropriate hedge ratios relative to fair value, with the committee ultimately agreeing to add 2% to international hedged equities, bringing the overall hedge ratio across all international exposures, including infrastructure and property, to approximately 35% of the total 30% international allocation. The second adjustment focused on duration positioning within the defensive allocation. The portfolio has had very low duration up to this point. Rather than increasing overall defensive exposure, the committee agreed to slightly extend domestic duration by reallocating from shorter-dated domestic bonds. Specifically, Australian short duration was reduced from 4% to 2%, while increasing Australian long duration from 9% to 11%, effectively pushing out along the curve without changing the total defensive allocation. This change is also because domestic 10-year bond yields are around 4.8% at the time of the meeting. Members noted this move is quite marginal and represented a gradual measured approach to positioning rate hikes not coming to fruition. The committee acknowledged the substantial short-duration exposure remaining in the Australian credit FRN allocation provided continued defensiveness to the overall portfolio. Meanwhile, the committee retained its concerns around global duration and wishes to keep this very short.